Imagine being in your late 60s or in your 60s and you invested your entire retirement fund in a 200 multifamily deal. And now you're lying awake and wondering if you have to go back to work. No distribution, no regular communication, occupancy is at 35%, and suddenly retirement feels uncertain. What would you do? My name is Bibi Ofuri. I teach people how to become financially free with multifamily. So let's dive right in. I've seen this before. In short, it recently happened to us, but our case is different. Has happened a few days to closing. So regardless, we did everything we needed to do. The lease order, the due diligence, but a few days to closing, the seller did that. I'll come back to that story. Let's concentrate on this question. An LP invested $200,000 in a multifamily deal. The property underperforms, distribution stops, and occupancy crashes. And immediately the mind of the limited partner goes this way. Oh, my money is gone. Oh, my entire retirement is gone. Oh, I made the biggest mistake of my life. No, panic is the fastest way to lose leverage. If you're an LP, first, stop assuming the deal is worthless. So if a property is currently distressed, with this scenario that you've given to me, it does not mean that everything is gone, especially when there are multiple number of years to go. With what I heard, this deal closed late 2024, and there is a 5-year loan debt on it. So that means the deal has a life cycle of 5 years, and you've only spent a year and a few months, or not even up to 18 months. Due to this, there are different outcomes that could happen. That is if the operators really know what they're doing. In some cases, they could be repositioning potential. The property just needs time to build value. Like I always tell people, not all properties are the same. The standard time for a property to be stable after closing is typically between 6 to 2 years. So if you buy a property and things are not stable in 6 months, does not mean that the property is bad. Or if it's not stable in 1 year, does not mean that the property is bad. All that it requires is, are they executing the business plan? Did they do their job? When I mean job, I mean due diligence. Did they follow the multifamily fundamental? If they did all that, then each property have different timelines for stability. So that might be the case. That might not also be the case. What if these are bad operators, inexperienced one, they didn't do their due diligence? Then that's a different outcome. You will not have the outcome I just said. No, that will not be your outcome. It will be something more devastating. So a distressed property does not necessarily mean the deal is dead. So what do you have to do as an investor at that point? Pull your operating document. For those of you that don't read your operating document, maybe this will compel you to do, but you would rather do that before than after. So if you're in this case, pull your operating document. When I mean your operating document, I mean your PPM, your subscription doc, because your power as a limited partner is inside those documents. All you need to do, I know many GPs will not like that I'm talking about this. I'm also using it to put myself accountable and responsible to my investors. So all you need to do is look for different clauses on those documents that covers GP removal rights, voting thresholds, reporting obligations, capital call clauses, and dilution provisions. Most LPs never read this part of the document. You know I'm saying the truth, right? The next thing for you to do is to ask for the current financials, that is the current T12, rent roll, delinquency report, age receivables, bank balance, loan status, recovery plan. If transparency is refused, then now's the time for escalation. So the next step is for you to organize your LPs, because one LP complaining is noise, but multiple LPs requesting accountability is called governance. That changes the conversation. So the question you need to ask the sponsor at that time is there an LP contact list? Peradventure, you don't know any other person on the deal. And that is really common. Has anyone else raised concerns? If needed, form a communication group with other LPs. So now this is a very critical part. Determine if this is fraud or failure. How do you go about that? How do you identify which is fraud and which is failure? Because this is critical. So let me tell you what fraud looks like. So fraud looks like this: fake occupancy number pre-close, fabricated collections. Some sponsors can be desperate. I can tell you that. Funds misused, undisclosed related party transactions. So sometimes there will be other parties involved and not disclosed to you guys. So what does failure really look like? Overestimation of rent growth, that's what it looks like. Poor tenant screening, that is very common with failure. Weak asset management. Are the sponsors or the asset managers, are they experienced? Do they even know what they're doing? Very bad property management company. and this is very common. So fraud equal to security attorneys, and if it's failure, it could equal to operational turnaround. So something could be done in both. The responses, like I said, if it's as a failure of misrepresentation, you need to get a security attorney. So if misrepresentation occurred in the offering document, that is a security law, not just estate law. You can only escalate this if you have your facts right. So you need to be careful as well. Gather your facts if they're right. So if it's failure, it means that failure does not mean fraud. It just means that the deal did not work, and that's not a crime. So let me reiterate again. Failure looks like bad tenant quality. The numbers were overly optimistic. Execution was weak. Management dropped the ball, or the market condition shifted, because these things happen. That's what failure looks like. Distribution stops. It gets redirected to payroll. It gets redirected to repairs, expenses, and even to pay the lender, the loan payment. At that point, protecting the assets becomes priority than the investors. But if after all that happens and nothing improves, these are the likely outcome. The property might be sold for a loss, or LP might get partial returns. That is, if you invest, let's say 100,000, you're likely to get maybe 50,000 back. That's a better outcome than selling for a loss and you don't get anything. Or if the sponsors took very high leverage, it becomes deeper losses. Maybe at that point, they have to bring a check at closing if they decide to sell. So fraud explodes, failure erodes, because failure shows up as missed projections, constant excuses, or stuffs like, we're working on it. I'll wrap up by saying, if you're an LP and you're dealing with a situation just like this, the first thing I'll tell you is don't panic, because these things happen. It's called an investment. Every investment carries risk, but multifamily has always been regarded as one of the investments that carries the most minimal risk, especially when it is done by an expert or someone that is experienced. But when it's done by someone that is not, then that's a different conversation. So the first thing I would tell you, like I said, is first, don't panic. Identify if this was as a situation of fraud or failure. If it's as a result of fraud, then that is deception. Then you know what to do. You need to speak with your security SEC attorney. And if it's failure, that will lead to bad execution. And really, that's not a crime. Remember to review your documents, request transparency, organize with other LPs if needed. And most importantly, these things happen when investors do not understand underwriting or how projections are done, because most people do not understand that underwriting a deal requires past experience, current experience, and future projections. It goes beyond just the numbers or maths. And that is why I recently just created my multifamily underwriting course. I am giving it out for a very small amount. In short, it's equal to nothing from now to the end of February 2026. And if you are a limited partner and you see yourself constantly investing in deals like this and going through scenarios like what we just discussed, this is the opportunity for you to safeguard yourself. Don't assume that you don't need to learn underwriting because you're a limited partner. In short, that's the reverse. You need to learn about underwriting because you have no control over it. You need to learn about it so that you know where to put in your investment. Our underwriting classes is going to encompass not just spreadsheets. We're going to be talking about different aspects of acquisition. Underwriting is just a portion of it. But if you want to learn acquisition, the total acquisition where the SEC is involved, what you put into your documents and all that. As an LP, don't you think that is important? That is the premium pack. If you're interested in learning more about how to understand the deals that you put in your money or the deals that you put in your hard-earned money, all you need to do is click on the link below and get started on your multifamily journey. Don't forget, we have limited slots, and from the month of March is going to go up. You don't have to go through bad experience to learn, but rather learn before you start up your experience so you can enjoy investing in assets like multifamily. I look forward to seeing you in my next underwriting class. Bye-bye.